Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a housing advisory services company. I want to talk to you today about the key housing events that have transpired in the U.S. residential housing market during the fourth quarter of 2020. During the fourth quarter of this year, a review of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University and the monetary policy actions of the Federal Reserve in response to the current and anticipated economic environment across the U.S. amid the COVID-19 pandemic were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview in mind, let me now turn your attention to the primary housing topics for the fourth quarter of 2020. During the fourth quarter of this year, the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the U.S. residential housing environment amid the unique circumstances of the COVID-19 pandemic. An important theme in the JCHS report is that a new national housing agenda is needed in the U.S. As a basis for housing policy, the National Housing Act of 1949 established the goal of a decent home in a suitable living environment for all. Unfortunately, in the more than 70 years since this landmark legislation, the country has not come close to this ideal, at least in part because there is no coherent national housing policy. As a proof in point, the issues raised by the JCHS State of the Nation's Housing Report in 1988 are still prevalent in the U.S. housing market today. The economic dislocation caused by the COVID-19 pandemic has underscored the fundamental importance of secure, adequate, and affordable housing for all. The pandemic has also shed more light on the millions of cost-burdened households that struggle to keep a roof over their heads. For example, in 2019, some 43% of Black, 40% of Hispanic, 32% of Asian, and 25% of white households spent more than 30% of their incomes on housing. To address the housing problem in the U.S., the JCHS set forth a national housing policy that appropriates roles and responsibilities of federal, state, and local governments in meeting the country's housing needs. Establishing funding sources and distribution channels for subsidies, creating incentives for efficient private production of housing through regulatory and tax structures, and ensuring the availability and affordability of mortgage financing, as well as the stability of the housing finance system. As 2020 began, The national home ownership rate had climbed back up to 64.6%, an increase of 1.2 percentage points from 2016. The number of homeowner households grew at a 1.3 million average annual rate over this period, more than making up for nearly a decade of decline. Single-family starts led the way, as September posted the strongest month for single-family home building in over 13 years. The monthly median sales price of existing homes averaged $281,200 through the first 6 months of the year, a 3.3% rise in real terms from 2019. While housing activity started the year strong, once the pandemic hit and the economy shut down, home buying came to an abrupt halt. For example, new home sales were down 14% year over year in April, and existing home sales were off 27% in May. Ironically, home sales over the summer proved to be strong for several reasons, notwithstanding the pandemic. First, interest rates dipped to historic lows as the economy entered a recession in March. Second, demographic changes favor home ownership. Moreover, the economic fallout from the pandemic has had a relatively modest impact on higher income households, another demographic group likely to purchase homes. Third, the pandemic disrupted the usual seasonal pattern in home sales, which are typically low during the winter months, increase in the spring, and then peak in early summer. Fourth, the pandemic itself ostensibly encouraged home buying. With growing numbers of adults working from home and children unable to attend school, some households are looking for larger homes to accommodate their need for added space. Residents of multifamily buildings may also be moving to single-family homes to avoid the threat of virus transmission in shared spaces. And fifth, innovations in home buying and selling have streamlined the purchase process in ways that allow social distancing. For example, virtual searches, showings, appraisals, and notary services. While housing activity was strong for some segments across the U.S., there were many significant problems with the U.S. housing market. For example, 9% of the nation's 48 million homeowners with mortgages, which is 4.3 million mortgagors, were behind on their housing payments. 6.3 million homeowners had entered forbearance plans by the end of October. Both the upfront and long-term costs of homeownership are still major constraints for first-time homebuyers. And the United States experienced 16 distinct billion-dollar disasters in 2020, making it one of the three worst on record. The cost of damages from these events was approximately $50 billion. As the chart illustrates, the U.S. home ownership rate began 2020 with some momentum. The Housing Vacancy Survey reported a national home ownership rate of 64.6% for 2019, up slightly from 64.4% in 2018. While still far below the peak of 69% in 2004, the home ownership rate had recovered by more than a percentage point from the 63.4% low in 2016. The number of net new homeowner households jumped by 1.3 million annually on average from 2016 to 2019. Home sales surged after a sharp dive in the spring. New and existing home sales started the year strong, but quickly fell at the onset of the COVID-19 pandemic. This fact is illustrated in the chart below during the months of March and April for new home sales and March through June for existing home sales. Ironically, home sales surged after a sharp dive in the spring due to the non-uniform manner in which the pandemic impacted the jobs market across the U.S. At the present pace, sales of both new and existing homes are likely to exceed 2019 levels this year. In terms of new home sales activity, year-over-year sales of new single-family homes were up 46% in July, 41% in August, and 32% in September. The summer surge put year-to-date new home sales some 17% higher in September than a year earlier. The robust market for new homes in 2020 continues the uptrend started in 2019, when sales jumped 10.7% to 683,000 units, more than double the 2011 low of 306,000 units. In terms of existing home sales activity, sales of existing single-family homes rose just 0.5% last year to 4.77 million units, while sales of existing condos and co-ops fell 3.7% to 579,000 units. Existing home sales overall were flat in 2019 at 5.34 million units. In the first quarter of 2020, the number of existing single-family homes for sale was already down about 11% year over year. Indeed, the supply of for-sale homes was at its lowest level since at least 1982. The pandemic made the shortage even worse because it kept many potential sellers from putting their homes on the market, thus leaving inventories off about 20% from year earlier levels from April through September. The number of single-family homes for sale stood at just 1.24 million in September of 2020, compared with an already low 1.6 million in September of 2019. From December 2019 through February 2020, housing starts were running near a 1.6 million unit annual rate for the first time since 2006. But when all non-essential activity was put on pause, annualized housing starts fell 19% between February and March, and another 26% from March to April, the largest one-month drop since 1984. New construction was back up to a 1.5 million unit annual rate by July and held at a 1.4 million unit annual rate in August and September. Single-family starts led the way, increasing to a 1.1 million unit annual rate in September, up 22% from the year prior, and the strongest month for single-family home building in over 13 years. A recurring theme in the U.S. housing market is that the supply of homes for sale has not kept up with demand, shrinking already tight inventories. Regulations on housing density effectively limited the supply of new housing and pushed up land prices, particularly in highly restricted markets with strong demand. The median price per quarter acre of land underneath existing single-family housing was $144,100 in 2018, up 56% from 2012. At the median, land prices thus represented 39% of the total property value. But in highly constrained markets, land costs accounted for more than half of the value of single-family properties. Again, the monthly median sales price of existing homes averaged $281,200 through the first 6 months of the year, a 3.3% rise in real terms from 2019. Prior to 2020, strong income growth and falling unemployment were giving a lift to housing demand. The median household income was up 4.7% in 2018 through 2019 to $65,000. Adjusted for inflation, the U.S. median household income grew at a 2.5% average annual rate from 2014 to 2019 and was 11% higher last year than in 2010. While all age groups posted gains in household income, the biggest increase was among younger households. Indeed, the real median income for households under age 35 jumped by 21% over the decade. The unemployment rate was cut in half from more than 8% in 2012 to less than 4% in 2019. Although strong income growth and falling unemployment were giving a lift to housing demand, and the economy was near full employment in 2019, some 37.1 million households spent more than 30% of their incomes on housing. Of this group, 17.6 million households had severe cost burdens, paying more than half their incomes for housing. Housing market conditions today are much less threatening than before the foreclosure crisis. Homebuyers are not as highly leveraged as they were entering the last economic downturn. Real home equity rose for 33 straight quarters from early 2012 to a new peak of $20.2 trillion in the second quarter of 2020. Mortgage debt grew only modestly to $10.6 trillion, and the ratio of aggregate home equity to the value of real estate thus held at 65.6%, the highest level since the mid 1990s. In addition to increases in household income, record low interest rates were enough to offset sustained price increases and reduce real home ownership costs in 2018 through 2020 for the first time since 2011 through 2012. With this in mind, let me now provide an overview of the U.S. monetary policy actions that took place during the fourth quarter of this year. In view of the economic impact of the global COVID-19 pandemic, the Federal Reserve maintained the target range for the federal funds rate at 0% to 0.25%. The Federal Reserve expects that it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. The Federal Reserve also stated that it will increase its holdings of Treasury securities by $80 billion per month and agency mortgage-backed securities by $40 billion per month to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. While it is logical to conclude that if the COVID-19 pandemic continues to curtail the U.S. economy, mortgage loan interest rates will continue to remain low or even inch toward more all-time lows in order to not impede housing market sales activity. However, the increased debt level that will inevitably be tied to more government stimulus may drive Treasury yields higher, which in turn will drive mortgage loan interest rates upwards. In accordance with the monetary policy actions of the Federal Reserve, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 2.95% and ended the quarter at 2.76%. The previous all-time low of 3.31% was reached in November of 2012, and the all-time high of 18.63% was reached in October of 1981. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary, finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Adkins Residential Home Valuation Analyzer. Moving away from the information in the State of the Nation's Housing Report, the impact of the COVID-19 pandemic on the residential housing industry, and the monetary policy actions of the Federal Reserve on the U.S. mortgage lending environment, and instead focusing on an assessment of the price level of homes across the U.S., it is important to note that for the fourth quarter of this year, 19 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Los Angeles, Honolulu, New York City, and Boston were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 2.76% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the respective justified percentage of household income amount. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $111,009 and $240,331. Based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, The justified home price level for the top 5 overpriced cities fell within the respective range of $330,258 and $550,210. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 41 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the quarter. Detroit and Jackson tied as the most underpriced city in the index, whereas Baltimore, St. Louis, and Indianapolis were identified as the third, fourth, and fifth most underpriced cities in the index. Although Indianapolis, Cleveland, Memphis, and Pittsburgh had the same justified percentage of household income amount, which was 13%, Indianapolis was classified as the fifth most underpriced city in the index based upon its higher justified mortgage loan interest rate amount, which was 10.75%. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 2.76% to more than the respective justified mortgage loan interest rate amount for each city, which fell within the range of 10.75% and 19.7%. Or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the cost of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.